Hey, what's going on? It's Ronnie G coming to you with another stock lesson. We're going to be talking about swing trading. We're going to be talking about my last position in KALY, and we're going to do a recap on that. Then we're going to talk about the overall market. After that, we're going to jump into what to expect from the future in YMC, the things that are going on, the things that are changing. We'll be discussing that. And that's pretty much it. So let's go ahead and get started. I want to go ahead and get started on KALY. And for those that can see my screen, I am sharing it. And this is a recent position that I played. If I want to go ahead and zoom in right here, let me move my video so y'all can see me clearly. I want to go ahead and show y'all that where I got in, where I entered, why did I enter right there? Why did I sell right there? And just go over that. So let's go ahead and go to a 6-month chart so y'all can see exactly where I got in. Now, let me talk a little bit about, what I'll look for when I scan stocks. And this is going to be very repetitive, but basically, I like stocks that have recently spiked, as you can see right here. Within a year's time frame. Right now we're on a 6-month time frame, but within a year, I like to see stocks that have recently spiked. It's even more better if the closer the spike. The reason why is because the stock can spike again. People see that, people watch that, and it causes them to say, all right, this stock did this, so I want to get in on it too. And you can bank off that. You can bank off people jumping in, wanting to buy off that reason because, once there's a lot of buyers, what happens? The price increases. So I like to see that. So I seen that in KALY. I seen it. And I was like, I think I want to buy into that. Now, the second thing I look for, I don't want to buy after the rally. I want to buy at the bottom because the objective is to buy low and sell high. So you want to buy it for a lower price. You want to buy your shares for a lower price and then sell them at a higher price. So this is what happens here. The stock spiked up recently. It fell. And what happens? It started to consolidate. What does consolidation mean? It means that there's an equilibrium between buyers and sellers. So there was an equal amount of buyers and sellers, and it causes the stock to have a support area. What is a support area? A support area is where the stock price is being bought at multiple times at this price level. So for this stock, I seen that there was multiple times where this stock was bought up at 1 cent. I seen that. And that's why I drew this white line. I drew it so that people can see what I see. I drew it for myself so I can understand where is the actual support area. So we call this dip buying. So I seen that there was a support and I was like, I want to buy. So it touched again right here. And this was the 12th of February. And I bought. Now, people say, all right, so what happens if it doesn't support? Well, I set a stop lower than the support. So I set my stop, 1 to 3% below the support at this previous low, because this is a previous low. So I bought the dip and I sold up here at basically 10 cent and 13 thousandths of a cent. This is a true penny stock. Now, yes, I could have held longer. I could have sold up here, but I was waiting for the stock to rally again. Now, it hasn't quite did that, but it has rallied. Don't get it wrong. It has rallied since I bought. It's rallied up 40, 50% since then. So there was obviously a great buy opportunity. That's 50% since the support. And it has rallied. So I could have sold up there. I didn't want to. I wanted to wait until it went up there. But I went ahead and sold at 1 cent and 13 thousandths because I wanted to liquidate all my accounts. So I'm doing something very special. Something that I should have done when I first started trading stocks and making money in stocks. Some of you guys are not there yet, but the guys who are there, who are making money consistently in the stock market. You have figured out your edge. You are disciplined to follow your system, and you don't take too many losses, and you're building your capital. You need to start considering paying off your debts. The debts that maybe you use leverage starting out with the stock market. Maybe you have student loans. Maybe you have a car loan that you want to pay off. So I went ahead and sold early this day because I wanted to liquidate my accounts to pay off some of my old debts. Now I know it's in the beginning of the year, but I can get in after I finish paying my debts. So that's my plan. That's why I wanted to liquidate my account. But I wanted to specifically go over this stock again because as we see, this stock is continuing to rally. So right now, today it closed at 1 cent and 23 thousandths of a cent. So that's good. It's continuing to rally, which is great. It dropped here recently. The past week, it did drop after a rally. It dropped, but now it's going back up again. Could it break this level of resistance where it fell before? I think it can. I really think it can. I think it can repeat this. I think there's going to be a spike. Maybe not as, you know, maybe not as high as this spike or where this went in price, but I think the spike can be big enough to see some great returns, especially if you already have a position like myself. So I, I could have held longer, but I had to liquidate my accounts. I wanted to go ahead and start, kind of churning down on my debts that I have in the past. And I'm doing that. And I feel good because I don't have anything weighing me down in monthly payments and paying off lenders and loans. And I'm just paying it out, getting it over with, starting from scratch, and doing that. And then I'm going to return to the stock market. So that's kind of the update on where I'm at. I will continue to teach my method of trading. I will continue to be a consultant for you guys. Some of you guys are inspired by me, and I'm very grateful for that. And I had to think about that. I want to continue. I'm going to continue trading, maybe with a paper account. I'm going to continue to test different things out, but I will stick and remain to my strategy, the thing that has made me the money today. That requires a lot of discipline. That requires, a lot of time to learn it. But that's my recap of Kaylee. This stock is, averaging millions. Today it hit 9 million in volume. So the stock is highly volatile. You can trade it. I did, I banked on it. So I bought, nice size shares and I profited a little bit. But that is my recap on that. Next, if you have any questions on that, you feel free to email me. You feel free to hit me up in the chat room. But this was a nice position where I bought on the support, and it went in my favor. Now then again, it did take a little longer, 21 days to be exact. Like it's like 3 weeks in business days, but 21 days, and I feel pretty good about that trade because it didn't do what I really wanted to do, but it did what I thought it was going to do. It did go up from where I bought it, and I think this stock is not worth as much as it should, but I think that it can increase in price. It can hit the 2 cent range, and I think this stock, that's kind of my analysis on that stock. So it is a consumer discretionary stock, so it is a pink sheet. So beware. Just be cool about that. Lately, let's go into the next thing. The next thing is the overall market. I wanted to kind of cover that and kind of give y'all my sentiment on that. I'm going to increase my time frame to 2 years. So over the 2 years, we have seen this uptrend. We all experienced a big downfall. Since 2008, we had never seen a downfall like this again. So now in 2019, 10 years later, 11 years later, we had a big downfall again. Now it's 2019, and we've had a rally at the beginning of this year, and it's been great. Now we're starting to see another, pullback happening right now where the prices are decreasing. And I want to note that If you notice this uptrend right here, this is a support of the old uptrend. This right here is a resistance. So what happens is that support can return into a resistance. It can become a resistance, and that's exactly what happened right here. Is that the stock? This IWM, this index has obviously been in a rally, and it's pulled back. That became a resistance point right here, and now it's pulling back. Now, when can it go back up? Who knows? But the stock market is still in good condition. Okay. If you look at the Dow, kind of the same thing. It was getting back to its range and it's pulling back now, which is perfectly normal. Just like the NASDAQ, which is the tech index. For all you tech companies out there, that's basically the same thing. Same things happen right here. We see a resistance right here, which I drew out previously, and now it's a slight pullback right there. It's a slight rejection, but that's perfectly normal when the market has been going up for 2 months straight. So hope you took advantage of this previous 2 months. If you haven't, shame on you. But if you have, or maybe you have failed, that's okay. After pullbacks, stock markets or stocks tend to rally again. So that's just the normal cycle of the stock market. Let's go to the S&P 500. Same thing here. I can actually draw this one out for you guys. I see multiple points of when the stock hit a certain level and it's fell. And so I see those multiple points. I'm going to draw a line connecting these multiple points, and it gives you a clear view of where the resistance could be. Now, this resistance, once it's broken out of, or if it ever does, it can turn into a support. But right now, it's acting as a strong resistance because it's happened multiple times. Who knows if it's going to, rally up this week or next week, but you can look at previous supporting points and see where the stock could bounce and rally. So you have a resistance right here, old resistance right there. You have resistance right here, where the stock may create another support. So if it bounces around this price area, it could bounce and it could potentially rally up. But that's just going over the index. Went over my Kaylee position, but yeah. So for the overall markets, pay attention to these markets, because if you don't, you won't know when it's a good time to invest into some stocks, some individual stocks, or when it's a good time to make that trade, whether it's long term or whether it's short term. Um, you got to know. So you want these stocks, you want the overall markets to hit a supporting point. You want them to begin a rally. See, when the indexes start to rally again, that's when you start looking at stocks to trade, because you want to catch the beginning of this rally. Like this rally right here, you want to catch the beginning. Probably not the perfect beginning, like the perfect bottom, but right in this sweet spot. Same thing in other rallies. There's a rally right here. There's obviously a rally right here. A rally right here after a pullback. A rally right here after a pullback. And once you see those rallies happen, once you see an index, it's falling and then it starts to rise for several days, you want to start looking at some companies. I'll give it 3 to 4 days. Looking at some companies, seeing what companies are also in a rally, are also in a strong trend, or just have fallen and they're starting to turn reverse. So you want to catch that reverse. When you catch that reverse, you buy at a low price and you want to sell at a high price if you are bullish. And that's kind of like, that's what you want to do. That's how you increase your odds of winning. But mainly you have to stay disciplined in looking at these overall markets. Same thing I did with Kaylee. Like, this was a time period where the market was rallying. It was starting to rally. This stock fell and it started to turn. So what did I do? I took advantage of that. I looked at the hourly chart and I said, look, this stock is falling. It's continuing to fall. And then it started to bounce and it created the support. And I say, well, I'm going to buy some shares off this support. Even though it's still in consolidation, I'm going to buy some shares. And so when it starts to rally up, it increases my position. And I start to profit, and I sold for a higher price, not much of a higher price, but I sold at a higher price. I have a profit. Same thing. So when you catch the indexes, when you catch them falling, don't panic. Just find a supporting range on your chart time frame, and once you find that range, you want to look and monitor the index and see what is it going to do or how it's going to react once it gets to that supporting range. Like right here, I can. This is the previous rally, and it's falling. Right here is where I can draw a support and say, okay, the stock started consolidating right here. It pulled back a little bit, and then it went back up again. I can draw support right here. Well, you see that the price has already dropped past this price level. So I can go to the next one and say, look, this stock has fallen from right here. This resistance can be a new support. I can obviously draw support right here and say, well, the stock can support at this price level. People can buy at this price level. Why would people buy at this price level? Because it's a familiar price range. They can see that as a previous drop in price, and they say, well, that can be a new support because people can buy up right there. Because look what it did, it broke past right here. So they say, well, this was a point of price reference where the stock dropped in price when it reached this price or that value, and then it reversed and it broke past. So let's buy right here. And that's what most traders do. So you're going with the majority in this sense, and you can buy some shares. Once it starts to touch, sometimes it consolidates and spreads out, and then it rallies. So sometimes it takes a couple days to obviously bounce. Sometimes that bounce happens within the same day. I mean, it just happens like that. So once that bounce happens, then that's when you look to buy. It's when you look at stocks in this index to buy. When it bounces, not when it first touches, because it can touch and fall through like it did, yesterday. But when it bounces and it starts to go up, and you see that green, see a small amount of green, you can say, okay, maybe it's time to look at some stocks to buy. So then you go and whatever you have on your watch list, stocks that have fallen and they are looking to return, they are reversing, then you can buy that. And that's kind of how you play it. Same thing how I played Kaylee. Same thing. I bought right here, and it took several days before it rose up. I could have sold, but I wanted to see that rally. And then it rallied again, and then I sold that time, because I wanted to liquidate my accounts, and I wanted to hoard some cash. But I would still be holding if I didn't want to liquidate, because I think the stock, the price target can reach 2 cents before another fall. So that may take another week or 2 weeks. So I was basically in the stock for 3 weeks. So sometimes it takes a long time or a little minute for the stock to start rising. But the whole idea is to be in the stock before this happens, because you don't want to get caught chasing this, because if you do, you'll get caught in this bad boy right here. This one day it fell. I mean, what's the percentage on that fall right there? That is a major pullback. That's 55%. You can get caught up in that. And you don't want to get caught up in that. You don't want to get caught chasing the stock. When the stock is obviously it's overbought, it's like, what goes up must come down. And you see all this green. Yeah, it looks good to a newbie, but it looks really bad to somebody who wants to get a good price on something. It's kind of like going to a store. You go to a store, you see those Jordans, or you see that new purse you want, or maybe you see that new phone. Well, when it first comes out, like the price is extremely high, but over time, that price decreases. You don't want to pay the highest value for something. You want to pay the middle spot. You don't want to pay too cheap for something, because then if it's too cheap, you're like kind of worried, like, is this worth the buy? But you don't want to pay too much of a high price for anything, because you want to get the best deal. So same thing with stocks. This price increase, it was way up here, and it's not worth 3 cents. I don't think the stock is worth 3 cents. Not saying it can't get back to that point, but this is obviously a rally. So when it pulled back, yes, and it started consolidating, This is a nice sweet spot range. When you see this consolidation happen, you know that this is a nice range where okay, this stock is worth this price. And then when you start to see people buy, you'll see the price increase, and you want to already be in it at that point. You want to be in it, and you want to wait. You can see our bar right here. So right there, price increase. It could go up. I think it's worth 2 cents. I really think it is right here. I think the stock can reach here again, and I think it can reach within a month or two. So I look at that and say, all right, when the stocks fall, those are the stocks that I want to start paying attention to. I want to see where the support could be. I want to see the stock consolidating. Once I started to see it consolidate, I'm like, I'm gonna buy because when it's consolidating, it's obviously not wanting to go lower. It's not wanting to decrease in price. It's getting ready to increase, and that's how I look at it, and that's how I've always looked at it. And from that point of view, that's when you want to buy. You want to buy in the consolidation. You want to wait for it to rally once you buy it. And that's where patience comes in. That's where discipline comes in because a lot of people want to buy when it's already up 20, 30%. And doesn't make sense for people who are bullish because you're buying an overpriced stock at that point. It just doesn't make sense. And I mean, and some of you probably will listen to this and say, yeah, that doesn't make sense. You probably have, if you go back and see your losses, you probably have paid overpriced for a stock and the stock dropped the next 2 or 3 days. And you're like, why did it drop? And you're wondering, why did it drop so much? Because you probably, you bought overpriced. You paid too much for the stock. So, and it probably was a stock that just was way up too high. It's just not good. Like you're probably looking at the wrong time frame. But if you're looking to hold for a couple of weeks to a month, then yeah, you want to look at hourly charts. If you're looking to hold for some months, under a year, then you want to look at some daily and weekly charts. And that's just what it is. You'll get a better view of what the worth of the stock is. And that's how you want to look at it. But that's my take on my last position in the overall markets. I want to look at a stock that I alerted. This stock right here. I told y'all to buy. I alerted to buy within the consolidation right here, and I seen that this is a support, and I seen that this is a pattern, and the breakout did happen. It did happen, ladies and gentlemen. That's 43% increase in price. This is a mid cap stock, so it's not a small cap stock. It is very more. It's not as volatile, and it's not super dangerous. This is real company. So, and I don't mean that penny stocks are not real companies. Most of them are BS companies. They're just BS companies, and they're not worth nothing. But this increase did happen. I seen that it just after it fell for so long, it was already up so much and it started to fall. So I seen that. I like to see this downfall happen, and then I like to see this base happen where so many times it's tried to decrease more and more, but it's just not, and it starts to go up. And then I say, all right, I missed that rally, so it's going to do it again because it's obviously going to repeat. It's a downtrend and uptrend, downtrend and uptrend. That is the cycle of the stock market. And I say, all right, it's been on a downtrend. Now it's not going any lower. It's consolidating. It's going to continue to go up for a while. And so I'm going to get a meat of that. And so I seen this consolidation happen, and it increased some more. So I didn't buy the stock. I bought Kaylee instead. But this is just one of the stocks I wanted to point out that you look for a stock that doesn't want to decrease no more. And it's already been on a downtrend. So you see that it doesn't want to go lower in price. And it's been on a downtrend for so long, and it starts to turn up. Those are the stocks you want to buy. You want to buy that dip. You want to buy that support, and you want to hold it. You don't want to be too quick to sell. If you got to hold for a week or two, do that. If you got to hold for a month or 2 months, do that. And get the price that you think is worth. Sell it for a price you think is worth. And that may be a 20% increase in a month. That may be a 10% increase in 2 weeks. So that's how you look at investing, period. Or that's how you look at trading. If you're more on the short-term trader side and you want to hold for 2 weeks tops, then yeah, you want to catch that movement. So you want to catch the stocks when it hits a support. But you first got to find the support. And how do you find the support? You just look for multiple points where the stock has decreased and it hasn't went past a certain price level. Price level may be 17 bucks, 18 bucks, 20 bucks. In this case, it was 18 bucks and 29 cents. And that's where I seen that. So, okay, this is a good buy point. And then here's a resistance. If it breaks the resistance, this thing can really go. What's going to happen again is at this rally, it's going to fall back, which it's doing now, and it's going to find another supporting range. And I'm going to see, okay, if this is a support range, it's going to touch multiple times. This is what stocks do. They fall, then they go up, they fall, they go up, they fall. And then it's multiple times where it just doesn't go past this certain price point, and it falls, and then it just spikes up, finds a new level, and then it does the same thing. Falls, and just repeats until it starts going a downtrend, and now it's falling, consolidation, it spikes, falls, consolidates, spikes up, and it's more of a downtrend because these low points are getting lower instead of getting higher. So you want to trade the uptrend where the lows are getting higher, where these consolidations are getting higher, not when they're getting lower and lower and lower every time it happens. Like right here, like these lows, this bunched up mess right here, these are candlesticks bunched up. These lows, they just keep getting lower, and that's what you call a downtrend. Now these lows are getting higher. When they happen, they're getting higher now. That's where you know you're in an uptrend, and this is where you want to buy, and then you want to wait for the spike, and that's how you do it. You continuously do it, but you got to be disciplined. You can't just say, it's in the rally, I'm gonna buy right here. You don't know if it's gonna do that. We know now because we looked at it, but you don't know if it's gonna do that. You just don't. But you want to buy those support, and you want to set your stop underneath the support, and then wait for it to spike up, or the price where you think it's worth, and you want to sell it at that price. You buy candy for $1, but you think it's worth $3. You want to sell it at $3. You just got a good deal. So you find a good deal on something, then you flip it and sell it. Same thing with stocks. But don't be too impatient for that increase to happen. Don't be too impatient. Sometimes impatience happens. It follows us in, but you don't want to be that person. You want to let it work out. And if it doesn't reach there, then you can sell early. You say, I thought it was worth $3. I bought it for $1. I'm just going to sell it at $2. It's been 3 months. I mean, dang. But in this case, if you have a time frame, like I want to sell within 2 weeks, maybe sometimes you might need to hold it for another week. You got to use common sense in this area and use your technical analysis. If you see previous resistance points and you see it just won't go past this point, sell it. You see it keep trying to touch and increase, and it just won't increase past, let's just say $32. Let's just see it won't increase here. Let's just say this thing goes back up and it won't get past 30, and it's done it twice already. Go ahead and sell it. Like, maybe it's not worth that, and people are not interested in buying it. It doesn't reach the demand of people. There's not a high demand for that product or for this stock. And I'm using consumer sense, like as far as buying and selling in the marketplace, whether you shopping for shoes or cars, I'm using the same type of sense in the stock market. It's buying shares of a company. Maybe this company's not worth it, so nobody's buying it, and it's causing it not to surpass a certain price level. And so you can sell it. Maybe you're not going to get all your money, but you'll get your money back and then a little bit of something, or maybe it drops on you and you bought it at a higher price. It drops on you, sells you out. Don't be upset. You just took a loss. Losses happen, but you had to stop. You're like, man, I don't think it's worth this much, but also look, if it drops past this point, sell it back. I don't want it no more. And that's how you got to look at it. You can't be emotional about it. You can't be emotional with money, which is the hardest thing to accomplish. really is the hardest thing to accomplish. But it's something that has to happen. You got to take your emotions out of money and buying and selling, because if you don't, you will get screwed. You will get screwed. You will be upset. You will let your emotions get the best of you, because there's going to be a lot of bad deals. And if you can just be right, the smallest portion of those deals, and be right and catch that big break, you will catch it. But if you're emotional, you'll start making emotional decisions, and you won't master money. You won't master investing, understanding the value of something. You got to understand the value of things. And once you do that and get in the process of, being disciplined and finding the supports, finding uptrends, trading only uptrends, and you have a system, stick to it. And then it's up to you from that point to stick to that system. Don't waver. Don't allow nobody else to make you waver. And that tends to happen when you're taking a lot of losses using your system. But if you know your system works, if you have won before, it can be replicated. It's just tough because you got to have extreme discipline. You got to be like a robot. Like robots, they are programmed what to do, and they don't do anything outside that program. You got to be like that. Sometimes humans, we all just make that risk. Like, hey, I don't know if this worked, but I'm gonna try it. But if you already have a system, it doesn't make sense for you to be like that. You know. Now, if you see that your system is no longer winning, then yeah, you may need to adjust it, but stick to that adjustment as well. You know, don't just waver from anything just because it looks good or you heard that it looks good. So that's kind of my take on first my Kaylee position. Finding the uptrends. Examining and monitoring the overall markets, letting that be your engine to see if you want to trade, because the engine may not be good. Like right now, the engines are not good. If the VIX is green, don't trade. If the VIX is green, always. All right. Now, if the VIX is red, you might want to trade. Right now, the VIX is green and all the overall markets are red. The VIX does the opposite of whatever the market does. It is the volatility index. So understand that. Once you see that these are green and the VIX is red and it's been red for several days and it's starting to rally, when the VIX is in on a downturn, that's when you want to trade. When the VIX is in a rally, you don't want to trade. So I don't want that to confuse anybody. But when you see the overall markets are trending for a couple of days, and you see that it's going to continue to trend, or you can see that technical analysis shows you that there's an opportunity to continue with least possible resistance, you want to look for stocks to trade, and you want to stick to it. So that's the deal with that. So once you see that, you go on your scanners and to the collective markets that you are examining. If you are small cap, you want to look at IWM, small cap and under. If you are trading mid cap and up, you want to look at mid cap scanners, large cap scanners, and you want to examine the Dow, the S&P 500. Nasdaq is more for any tech company out there, any tech company, computer information company. The NASDAQ is something you're following. So if it's a technology company and it's in that sector, if the NASDAQ is good, you want to look for tech companies. So same thing. You can pick and choose how you want to trade. I think if you're more on, high risk, high reward, then yeah, anything on the small cap, you want to look at the IWM. If you are more on the between the investor and trader side, where you don't mind holding it for a month or two, then the mid cap scanner. Mid cap scanner is for you, and it's easier to find trends like that. But just like this right now, like you don't want to trade this right now. Yeah, you see green and it looks good, but no, like you don't see a recent fall. You just don't. You got to wait for that thing to fall, and then you find that support and buy that support, and then let it rally again. You don't want to buy right here because this thing can topple in the next 3 or 4 days and you lose. So this is overpriced right now to me, and that's kind of how you want to go through your stock list. Like you don't want to trade anything that's super high. You want to catch the bottom. You want to catch the bottoms. This is in a rally. Want that thing to pull back a little bit more, and maybe this area right here from where it fell before, maybe this can be the new support. I want it to fall, base out, buy, set my stop, and then let that thing ride up Like that's how you want to look at the stocks. Don't pay overpriced for these stocks. Find a good area. Like find a good deal. Don't overprice. Don't if you see that green, don't get too excited. Green is just like a sell sign or a discount sign. They just trying to get you to buy. You know, buy when it's worth it. Like this right here, this stock has fell. Like it's fell a lot. This can be a possible. All right, I'm gonna buy and let that thing ride up because it still has room to ride. Yeah, it still has room to ride. Maybe that's not within your percentage of what you're looking for, but this thing has room to rise some more. But you want to find the stocks when it's basing out, and that's how you want to. That's how you want to trade. And these are mid cap stocks. If you're trading small cap, like same thing. Like you want to go through your list and see what has fallen, and it hasn't rallied that much yet. And that's those are going to be your best deals. Just honestly, like this right here, this is falling. It's falling. It looks like it doesn't want to drop past 571. Now, if that continues to happen the next 3 days and it doesn't drop past, it's going to increase in price. People are buying into it, and it may not, but it's most likely going to increase in price. It did the same thing right here. It just wouldn't. It failed touch. It just wouldn't get past this price point. It wouldn't fall past it, and it increased. That's how you want to look at the stocks. That's how you want to look at any company. It's just it's that simple, but it's hard to do because you got to have discipline. You got to have all these things in order. You got to have your system in order, knowing when you want to buy, when you want to sell. You got to have your indicators and stuff like that. Don't complicate it. You know what has won you money before. If you don't, then that means you need to test it out. But you know what has won you money, and you can see the type of stocks and the type of chart and what the candlesticks was doing and what price level it was at. You can mark those things down, note those things down, and test it out. How many times once a stock does this, exactly what's on my list, what is the probability of it going up again, and do that 10 times in a row and see what is your range of winning, like what is your probability of winning with that system. Test it, quantify it. If you test it 10 times, you win 6 out of 10 times, that's a 6% winning percentage of all those variables in line with all those different type of stocks, this price level. If all those things match and you test it and you win 6 out of 10 times, you have a 60% chance to win. You got to quantify it. If you're just out here you're just throwing your money out there and don't know what you're looking at and what variables are in place, then you're a crash dummy. And you don't want to be a crash dummy. But if you do that, you will be a crash dummy. But you're not a crash dummy. I believe you're not. I believe everybody's not a crash dummy unless they want to be. So um, you want to quantify it, and that's why like I look at the same thing. Like this stock has fallen, spaced out, it rallied, pulled back, based out, rallied, and it's eventually going to have another pullback. This can be considered a slight pullback or a consolidation where the stock just didn't want to drop past this point. Now it looks like it's going to rally again. Who knows? But you can take your risk on that. I wouldn't take my risk on it. I need to see a nice pullback. Like I need to see it look really good. Like, and what does really good look like? Just this. Like I need to see a long trend of that happening. Kind of like with HUY. Like I see this long, nice diagonal trend of this just falling down and then it's curving up. And those patterns are easier to trade. I'm just telling you, they're easier to trade. But that's my recap. Just identifying the trends, quantify your trades, quantify your trades, meaning like look at all the variables and are you winning on those variables? Are you winning with those indicators? If you're not documenting, if you're not testing, like you're gonna fail as a trader. You just are. You can't just be throwing your money out just because it looks good or you heard it looks good. Like you just can't do that. You just can't. So quantify, test, have a system in place, rinse and repeat, and be disciplined. If you're not a disciplined person in your outside life, you're not going to be a disciplined person inside of trading. Anything that you do, you have to be disciplined in all areas. Like you just have to. So That's basically what it comes down to. It really does. So that's what it's going to take. Figure it out. I help you figure it out. Like that's why I'm walking you through the process. This is helping you figure it out. If you don't follow the process, and then it's just not going to work. You got to enjoy this process of figuring it out. Because if you don't enjoy that, you won't have longevity at this thing. Probably won't last a year or two. You just won't. And that's just the realization of it. I've been learning the stock market for 4 years. You know, and I'm enjoying the process of learning. So that's what it takes. It's just what it is. So that's it. That's pretty much all I have. I'm opening up to Q&A. So if you got a couple questions and or, maybe you have a stock, I can quickly look at it, give you a brief analysis, and kind of give you my 2 cents on it. It just depends. Yes, with my outlook on it, um, you know, it depends on your lifestyle. Like it makes more sense to actually hold stocks for the trend. And I'm just being brutally honest. It makes more sense, to do that. It just does. The reason why I say that, I mean, the money is in the trend. It's in the up and down, going up and making higher lows. The lows are being higher in a sense. They're going higher. When the lows do happen, that's where the money's at. And so, yes, you could expect me to hold longer. I held that for 3 weeks. I held stocks for a month or two before, but that wasn't my thing, of doing that. I wanted to have the fast money. I think that in this market condition, that's not a good idea. Like if you see a trend, go for it. Hold that stock for a month or two. Be patient. Maybe you hold for a month, maybe you hold for 3 weeks, but when you look at day trading, when you're trading a stock within that day, I mean, you're just looking for fast money. And what happens with fast money? I mean, it dwindles away quickly. It just does. So you have a lower percentage of winning with day trading. With swing trading, your percentage is higher, but with trend trading, it's a lot higher. It's a lot harder to make more. It's just in the sense that you got to have a larger account. You don't want to be swing trading or swing trading or trend trading with a $2,000 account. You want to have at least 10 grand. With your account, and if you don't have that, save up for that. Or use leverage. If that's what you want to do. I'm not too keen on using leverage at this point or this market conditions because these market conditions are very unusual. It's not like we've been in an uptrend for 2 years straight. We are now getting back at that point, but you can't expect me to hold longer just because, like, I mean, I'm just not looking for fast money at this point. And I don't think people should look at fast money, no matter where you're at in your career or where you at with money. If you have 10,000 grand, $10,000, then yeah, like if you find a mid cap stock that is doing really good, and it looks like it's going to be in a long term trend, then yeah, buy that. Like the stock right here, buy that. And hold it and see how it increases. And you don't have to be in a rush. But the money isn't within the trend. It really is. The money is within the trend. Hold it for that trend. Or hold it for a price point of where you want to see it. If you see it only increasing 50%, if you want to only take 20% within that trend, maybe that takes 3 weeks, then yeah. I think with swing trading, holding under 2 weeks time, that is very, very difficult. You got to be more disciplined than you are with trend trading. You got to be super disciplined. Um, but the long term game, if you want to do this for a long term, you're not looking for quick money, quick build up, then yeah, go for trend trading. Hold it for a month or two, 3 months. If you want to hold it until you get the 30% return, then do that. Maybe that takes 2 or 3 months. But you grew your $10,000 account, and It may have taken longer, but within that 2 or 3 months, you're not taking a lot of losses on swing trading, trying to get to that one win. So finding that trend, yeah, that may be simple in a sense, but are you going to be disciplined to wait for that uptrend to start rising up? Are you going to be disciplined to take a chance on that support area where like the stock could increase at this point or it could decrease? Are you willing to take the risk? So yeah, long term, um, it's all I'm really worried about right now. And I don't mean long term as far as investing where you're holding more than 365 days. I'm talking about, holding for that spike, buying the consolidation and holding for three or 4 weeks until it spikes, finding that trend. Like this stock right here has a nice downtrend right here. Now it's getting to a point where this thing is not wanting to drop past this price. And I'm glad I found this. It's not wanting to drop past this price. It's done it multiple times. It doesn't want to do it. You can buy this and wait for it to increase. And it may take 2 or 3 months. And if you got 10 grand, that's worth it. That's worth it. If you buy it at this price, and you're looking for an increase and you're waiting for it to increase, you say, hey, I want 20%, then wait for your 20%. That your 20% may take 2 months. It may take a month, but you got 20% on your 10 grand. You just increased. And then you do it again. Or now, 4 months later, you're at 20 grand. You just increased your money. Whether it takes you 2 months or 3 months, it doesn't matter if you can do that in a week, because it's slow and steady. Slow money lasts forever. Fast money, it doesn't get you anywhere. I mean, you can make fast money, but you'll lose it too. So that's why I don't do day trading. It just doesn't make sense long term because you're going to take a lot more losses than you will wins, with day trading. Swing trading is right on the board. It's in the middle of that, taking a lot of losses and then having a lot of wins. But think about it. You've been in a trade and you're like, man, I think I'm losing, and then you see it go up later. It's because you realize you should have stayed with the whole trend. You should have kept it and held it. And that's okay. Like it happens. But you can see from that moment of that happening that you're going to have more longevity, less losses with long term or shorter long term trading. Let me say that short term, longer trading, holding for a month or 2 or 3, and you're going to see a lot more longevity in that. It's kind of getting you ready for long term investments. Yeah. Now, does this type of trading require you to monitor the news and the earnings? Yes, it does, but um, that's a little bit of fundamental. So you use technical analysis and fundamental analysis. You just use a little bit of fundamental analysis. You see what's going on behind the scenes with SEC filings, and you do a little bit more research. But so what? Like little more research is not going to hurt you because you're holding for a longer period of time. Just to answer your question, I can't stress enough how important it is, though, that I'm seeing the longevity more in that, after I've made, money doing swing trading, but it was very risky and I've had some big losses. I just have. And I've had big wins to cover over those losses. And yeah, like you can make money, but you got to be super, super disciplined and on goal at all times. I'm just getting to a point where I'm just saying I'm adding more to my portfolio rather than just stocks. And I find the longevity more in holding longer. If I'm doing it myself, if I don't hire a broker or a financial advisor, if I'm doing it myself, there's more longevity in holding it for a longer period of time than trying to swing trade it and watch out for it. Um, I'm just not into that game. That game, I see the game happening and it's catching a lot of people. What I mean by it's catching a lot of people are losing their money, like large amounts. TSG, share wise, um, share wise, with this price level, if you can afford, 500 shares here and there, if you can, take a 50% position, If you got 10 grand and you can take 50% of that and invest 5 grand, then yeah. But like I said, like having at least 10 grand to start with, very ideal. You know, 75% of your account size can go into that. Just don't put all of your money into that one stock. So when you talk about share size, yeah, you know, if your stop loss, like let's just say your stop loss is down here and you're at risk of losing more than 3% of your account equity, then you might want to reduce your share size in half. So that's about risk management. If you are buying up here, that's why I don't recommend buying up here unless you see a support somewhere right here where you can quantify your stop order, saying, okay, this is a support. That means I can put it to 2 to 3% below that. If you can't quantify that, then I say, yeah, reduce your share size. If your stop is down here and you bought up here, reduce your share size a lot because you don't want to put all your eggs in one basket. You just don't. It's not smart at all. So with this stock, yeah, like if the share amount right now is 17, 66. And let's say I want to use 75% of my account and I got 10 grand, then I can basically, factor in, okay, I'm going to use $7,500 for this stock and I'm going to buy $7,500 worth of that. Then I go for it. I calculate how many shares is worth that and I buy it. And I'm using 75% of my account. With TD Ameritrade, you don't have to do the calculation. You can switch over to dollar amount when you're buying shares. You can switch over to a dollar amount invested, and you can invest 75% of your account. If you're 75% of your account is 10 grand, then you can use that, and you can put 10 grand in your order, and it will get the shares for you. So you can do that now, and it makes it a lot more easier. But don't put all your eggs in one basket. Don't go 100% all in. Like, don't do that. Not on one stock. Not if you think it's even Microsoft. Like, don't go all in on. Like, leave some money over just in case. Have that 10 grand. Cool. Corey, I really appreciate you for being consistent with on the webinars. Everybody listening, if you don't come to the webinars, you really don't get any type of knowledge, no training, and you got to take advantage. But I'm not going to beg anybody. So I appreciate you, Corey, and anybody else. Maybe you had work. If you are watching the webinar, if you go back and watch it, that's great, man. You're being consistent as well. So, but for those who are inconsistent with watching webinars and you want to complain that you're losing, you're not going to get better if you don't get the right training from somebody who's successful. So continue to do that. Uh, thank you, Corey, for being on. And I wish everybody well who's watching this webinar. If you've got questions, hit me up. And I'll see y'all in 2 weeks. And I'll see y'all tomorrow in the chat room. All right. Peace.